Are you new to the home buying process and wondering how much home you can afford to purchase? Well, in today's video, we're going to discuss DTI, debt to income, in more detail and go over how lenders use it in order to determine how much home you can qualify to purchase. My name is Jeb Smith. I'm a real estate broker here in Southern California. My channel is all about real estate, helping buyers, helping sellers navigate that home buying, home selling process. So do me a favor, if you like content like this, hit that subscribe button and give me a thumbs up if you like the information in the video. If you have questions about something I've said, something you didn't understand, comment below. I'll go back and address that for you and help you understand the process. Again, my channel is all about helping educate and guide you through that, so I appreciate you taking the time to watch. So part of the pre-approval process is determining your debt to income. This is what lenders use in order to calculate how much home you can afford to purchase. So what is DTI? What is debt to income? Well, it's your total monthly debt divided by your gross monthly income. What does that mean, right? You're looking at me going, well, what's included in my debt? Well, it's things that often report on your credit report, things that you used your social security number to purchase oftentimes and would report on your credit report. Items like your car payments, student loan payments, credit card payments. Those items are primarily things that show up on your credit report, and those monthly debts would be part of what lenders use in order to determine how much home you can afford to purchase. Now, if you have alimony that you pay, child support that you pay, those are also monthly debts that may not show up on your credit report that would also be used in your debt calculations. Now, what they do is they take that total debt that they have and they divide it by your gross monthly income. Your gross monthly income is your income before any taxes come out. So for easy calculations here, we're going to say you make $120,000 a year. You divide that by 12 months, that's $10,000 a year in gross monthly income. That would be your income that the lender would use in order to qualify or in order to determine your debt to income ratio. They take that total debt, like I mentioned, and then they add your housing expenses that you're trying to qualify for in order to determine your total housing expense ratio and your total debt to income ratio when purchasing a home. So a debt to income, this could be very confusing, is made up of two numbers. It's a fraction. It's made up of a lower number and a higher number. The lower number is your housing expenses, so the total amount that you're spending on housing. That would include your mortgage payment. That would include your property taxes. It includes your homeowner's insurance on the property. If there's PMI on the property, that's your total monthly housing expense. That would be the bottom number of the fraction. And then the top number of the fraction, the bottom number would be your total debt. So they would take that housing expense that I just mentioned, the principal, interest, taxes, and insurance, and PMI if there's PMI on it, and then they would add any of those monthly debts that we talked about earlier, car payments, credit cards, student loan payments. And when they're talking about those numbers, they're talking about the minimum monthly payment. So we're not talking about the total balance, we're talking about the minimum monthly payment that you have to pay on those credit cards. So all of that debt added to your total housing expenses gives you that bottom number. Now, depending on what type of loan you're trying to qualify for will determine how much or how high your debt to income ratio can get in order to qualify. So now, conventional loans, like to see a housing expense no more than like 43% or so. Now, give or take a percent or two, but I'm conservative here in my conversation, but we're going to say 43%. So that would be your total monthly debt that I mentioned, plus all of those housing expenses that I mentioned, divided by that total monthly income. They don't want to see you spending more than 43% of your total monthly income on all of your debt. Now, FHA loans are a little more lenient in their guidelines. I've seen people as high as 57, 58% of their total monthly debt being used towards housing and other debt-related expenses in order to qualify for a home. So depending on which route you go may determine how much home you can afford to purchase, but just understand that FHA is going to be a little more lenient and allow you to purchase more home than conventional in most cases because they allow a higher debt to income ratio. Now, you're sitting at home probably trying to calculate your debt to income ratio, and while that's something you can do if you actually know all of the expenses that populate on your credit report, and you have the ability to use an online mortgage calculator and know the county property taxes and all that, you can get a really rough idea of how much home you can afford to purchase. But what I'd recommend is speaking to a mortgage professional, right? As a real estate broker and working with a lot of buyers, a lot of first-time home buyers who are looking to just start the home buying process, my first conversation with those buyers is to speak to a mortgage professional. And it's for this very reason. For one, to make sure that they actually qualify to purchase a home. Make sure that they have the employment necessary, the credit necessary, the assets necessary in order to purchase a home. But from there, that lender can guide them and tell them exactly how much home they can afford to purchase. What I often see is buyers looking at homes, going to open houses, looking on Zillow, Redfin, all of these websites, loving homes, and then calling a realtor or a mortgage professional after the fact, trying to get pre-approved and or buy a property. And that's backwards, right? It's always better to start the process with speaking to a mortgage professional, going through the pre-approval process, letting them look at all of that information that I mentioned to make sure you qualify. And then from there, they can tell you exactly how much home you can afford to purchase, either based on the budget that you have in place or the max amount that you can spend on a home. And from there, then you can contact a realtor. From there, then you can go out and start looking at property. And I realize that isn't as fun as just going out to look at homes, but honestly, it'll save a lot of heartbreak in the end. It'll let you know that, when you're out there looking, that you're truly qualified. And more importantly, in the market that we're in right now, it allows you to move quickly as you see a property come on the market, right? We're in a market right now where things are moving very, very fast. Homes are selling very, very quickly. So if you have that pre-approval in place and you see a home today, you can write an offer today versus going out, seeing a home, and then having to go through the pre-approval process and finding out maybe you don't qualify, or maybe you qualify for less than the home that you were interested in buying, and putting yourself in a bad position. So, debt to income is the key instrument that lenders use in order to determine how much home you can afford. So keep in mind, the less debt that you have, in theory, the more home you're going to be able to afford, or the more income you make versus your debt is going to allow you to afford more home. So instead of trying to calculate that on your own, do yourself a favor, speak to a mortgage professional. If you don't have one, reach out to me directly. I'm happy to put you in touch with a trusted professional, somebody that I know, or somebody that is part of my network that can take good care of you. If you do have questions, leave them below. And if you haven't already, hit that like button. I appreciate you taking the time to watch. We'll see you again soon. Have an awesome day. Bye-bye.